After a monster run, stocks naturally moving sort of slightly sideways today. They're higher. And make no mistake, though, it feels like there's going to be another huge move very soon. The bias is to the upside, but we're going to take our cue from a big week of earnings data, all tied into the American consumer. We're going to have earnings releases that will wrap up the entire earnings season, which has not only been better than expected, but this is the most important part, folks. These earnings have moved stocks higher in a big way, and they caught Wall Street flat-footed. On that, I want to bring in Gibbs Wealth Management CIO and President Erin Gibbs, First Trust Advisors Chief Economist Brian Wesbury. Erin, let me start with you, because last week all I'm reading about is all of a sudden these mutual funds are diving into the market, getting out of cash. Hedge funds are changing their outlook. Wall Street is like, okay, let's go into cyclical names. This economy is back. No talk of recession. I'm not sure why Wall Street had this epiphany so late, but they're having it.
Yeah, I think we've all finally come to accept this is the TINA environment. There is no alternative environment, that you should not be in cash, that you should really be in U.S. stocks. It's your best bet, particularly when we're looking at 2020. I think Wall Street was really just waiting for confirmation of what we were expecting for 2020. And with the Q3 earnings, we just got a better sense of what was going on. And so now we're reassured. We're all in. So between, the more stability outlook on Fed rate cuts and earnings, this is going to look good. It looks good for the next 12 months.
And Brian, to that note, it's interesting that Jay Powell met with President Trump and some of his key advisors, because last week he was on Capitol Hill. He talked with Congress both times. And I got to tell you, I never saw a more confident Jay Powell in this role yet. He was not only confident, he chastised and chided the Congress to do their job. He took a victory lap, and he more or less has assured us that this is good. We're going to be in a good place for a long time.
Yeah, I agree he was confident. I agree that he should chide Congress. Here we are in the 11th year of an economic recovery, and we still have $1 trillion budget deficit. Even John Maynard Keynes is rolling over in his grave. He believed in deficits, but not in the 11th year of an economic recovery. However, I would love to kind of tell you that I don't think the Fed needed to cut rates to get this rally going. I believe the fourth quarter of last year was a correction. In the middle of that correction, we wrote a piece. We expected the S&P to hit 3,100. It's over that now. We expected the Dow to hit 28,500. I think without the Boeing problems and the 737 MAX, we would be there today. And so this has followed our script. I don't think really that we needed those interest rate cuts in order to get this. We were never going to have a recession. But with those cuts, it makes it even more certain that next year is going to be a growth year. And I think that's what the market's realizing. Consensus earnings estimates right now are for 10% growth in earnings. Right. And we all know those consensus estimates are too low. So I'm looking for 12 to 15% earnings next year.
Erin, okay, now Wall Street says the coast is clear, but the market's at all-time highs, and this has created a dilemma, particularly for those fund managers that were sitting on their hands. And what we're seeing is a lot of buying in names that haven't moved. They call them value. Some are saying, okay, go with these value names, these cyclical names that are attached to the economy but have been beaten down. And this week we get a good sense of that, because we get a lot of retail earnings. And for some reason on last week, Macys and Gap stores were among the top 10 winners last week. Everything else that was up last week were up on earnings. So, is Wall Street in the dilemma where they're now trying to guess, and people watching this show, should they roll the dice on a stock like a Macys, which has been an unmitigated disaster, or go with the proven winners?
So when it comes to the big box retailers, I still think that there's a lot of consolidation that needs to happen in that space. So your Nordstroms, your Macys, any of those guys, I'm not ready to jump all in. I think what I'm more secure about are your companies like your Walmarts, your Targets, that have put heavy spending into improvements, e-commerce, expanding their footprints into groceries and other business lines. These type of retailers, as well as your home improvement, those I feel a lot more safer about.
All right, thank you both very much. Brian, thank you. Erin, stay there for one moment.